Hey everyone, and welcome to today's Explainer. Today, we are unpacking a situation that is literally keeping millions of Americans up at night. We're talking about the skyrocketing costs of home insurance. Seriously, if you've opened a renewal notice recently and felt your jaw hit the floor, I promise you, you are not alone. We're going to look really closely at the data today to understand why this isn't just some local issue, but a massive national structural shift in the industry that we urgently need to dissect. Here is our roadmap for today. We're going to run through the premium shock, the math behind the crisis, the insurer exodus, and the uninsured gamble before wrapping things up with the super actionable homeowner survival guide and a look at preparing for the new normal. All right, let's kick things off with Section 1, the premium shock, from safety net to financial burden. Okay, let's dive into this by looking at Karen. She's a retired teacher living just outside Sacramento. She's lived in the exact same house for 22 years, actually paid off her entire mortgage back in 2019, and she felt genuinely, totally financially secure. But then, last October, her renewal notice arrived. Her premium jumped from $1,840 a year to a staggering $4,100. She had zero claims, absolutely no major changes to the property. It was the exact same house in the exact same neighborhood. When she called her insurer, they politely explained that her zip code had been reclassified as having an elevated wildfire risk. So she tried to shop around, right? Well, two different insurers totally declined to even quote her, and a third came in at $4,600. Her policy just became exponentially more expensive overnight. Now, you might be thinking this is strictly a West Coast wildfire problem, but the data says otherwise. This is everywhere. Down in Florida, homeowners are paying an average of over $7,000 a year. That's the highest in the entire country. Over in parts of Louisiana and Texas, they're seeing carriers exit the state completely after these brutal hurricane seasons. And in the Midwest, homeowners in hail-prone corridors are getting hit with massive deductible spikes, specifically for their roofs. Across the board, the average U.S. home insurance premium increased by 24% between 2021 and 2024. That actually outpaces inflation by 11%. And honestly, the craziest part? 82% of homeowners actually expect their premiums to just keep rising in 2026. This is a structural shift, and it's happening everywhere. So let's look at why this is happening in Section 2, Math Behind the Crisis, Why Insurers Are Panicking. While digging through the data for this, one number literally jumped out at me like a jump scare. 27. That is the staggering amount of billion-dollar weather and climate disasters the United States experienced in the year 2024 alone. 27 separate events. And when you add up the damage from those 27 disasters, it hits an astronomical $183 billion in a single year. Insurance companies are paying out soaring residential property damages for hurricanes, floods, wildfires, tornadoes, and severe hail. The truth of the matter is, insurers aren't just being greedy right now. They are genuinely scared. They simply cannot quietly absorb these kinds of losses anymore, so they are repricing risk in real time and passing those massive losses right on to the consumer. To really grasp the mechanics here, we have to talk about reinsurance. Think of this essentially as insurance for insurance companies. It's how the industry spreads its massive catastrophic risks around the globe, basically serving as the ultimate financial safety net for the system itself. But here is the kicker. Because of all those massive disaster payouts we just talked about, U.S. reinsurance premiums surged between 45% and 100% in 2023 alone. The math here is cold and completely undeniable. When the risk profile of an entire region changes permanently, the old price becomes wrong. The industry is correcting that rapidly, which directly and heavily hikes up your renewal costs. Which brings us to Section 3, the insurer exodus, when carriers just walk away. Premium increases are rough, for sure. But the most alarming development by far is that insurers are simply leaving entirely. State Farm and Allstate both completely stopped writing new home policies in California. By early 2024, State Farm had non-renewed 30,000 homeowner policies and 42,000 commercial policies. In fact, 7 of California's 12 largest insurers have paused or restricted their coverage. And the reason? They cite catastrophe exposure. Basically, the likelihood of incredibly costly claims now completely exceeds the risk they are willing to take on. So when these private companies flee, homeowners get pushed into state-backed insurers of last resort. In California, that's called the FAIR Plan. And let me tell you, it is bare bones, it's expensive, and right now it's functioning way more like a trampoline than a safety net because, frankly, nothing else is available. In Florida, multiple private insurers actually went insolvent, which caused the state-backed Citizens Insurance to swell up and become the largest insurer in the state. That was never supposed to happen. And the downstream effect of all this? Well, without private insurance, you can't get a mortgage. This creates a very real risk of collapsing property values, lowered tax revenues for local schools, and entire communities just slowly hollowing out. Sadly, parts of coastal Louisiana are already living this reality today.
Moving right into Section 4, the uninsured gamble, the hidden trillion-dollar risk. While looking through the research for this explainer, I came across a really grim industry term, going naked. It refers to homeowners who intentionally let their coverage lapse because the premiums have just become completely unaffordable. And listen, these aren't irresponsible people. Many of them are just staring down a brutal calculation. It's like trying to pay $600 a month for insurance on a $280,000 home, all on top of their mortgage, their property taxes, and, daily living expenses. It's impossible. So they gamble. And this brilliantly illustrates just how massive the stakes of this gamble really are. According to a 2024 analysis from the Consumer Federation of America, 7.4% of American homeowners are now entirely uninsured. That leaves an astonishing $1.6 trillion in totally unprotected market value. Sure, some folks will get lucky, but others are going to lose absolutely everything to a fire or a flood, and they will have zero financial path back.
Okay, enough of the scary stuff. Let's pivot to Section 5, your homeowner survival guide, how to fight back. One of the biggest surprises hiding in the data is that your loyalty to an insurance company, it really doesn't matter anymore. Underwriting these days is driven entirely by data models, not relationship managers. If you just quietly accept a renewal, you might be overpaying based on some wildly inflated 2019 rebuild estimate, or you might be incorrectly assuming you have flood coverage, which, by the way, almost always requires a completely separate policy. The only loyalty that actually matters right now is the kind you negotiate. So, your best defense is following these 6 precise survival steps. Step 1. Check your true rebuild cost using tools like Xactimate or just ask a local contractor, so you ensure you aren't overinsured. Step 2. Shop your policy every single year using comparison platforms like PolicyGenius, Insurify, or the Zebra. Step 3. Ask your provider directly about hazard mitigation discounts. Step 4. Raise your deductible strategically, say to $2,500 or more, to save on those monthly premiums. Step 5. Bundle your home and auto, but always run the numbers separately just to verify it's actually cheaper. And finally, Step 6. Install a dual monitored security system. Because fires destroy the whole house, insurers absolutely love systems like Nest Protect or Simply Safe, and having one can easily earn you a 5 to 10% credit on your bill. I actually want to look a bit closer at Step 3 because it's probably the most underutilized tool out there. Before you spend a single dime on home upgrades, call your insurer and ask if they honor specific mitigation programs. For example, the IBHS Fortified designation can get you up to 35% off just for having wind and hail resistant roofing. There is also the IBHS Wildfire Prepared Home Program for defensible space, or the USAA wildfire discounts, which are available in 10 states for Firewise USA communities. You have to ask for these specifically. All right, wrapping up with Section 6, preparing for the new normal, from recovery to resilience. Let's bring this full circle back to Karen from the beginning of the explainer. Karen ended up getting a third-party wildfire risk inspection done, and this inspection officially proved that she had a Class A fire-rated roof installed 3 years ago, and that she actively maintained defensible space in her yard. By officially documenting this resilience, she secured a hidden mitigation discount that lowered her renewal quote from $4,100 down to $3,200. Now, it's not a perfect outcome, but she finally understood the system and she worked it intelligently. Which leaves us with a final question to think about. Is your home ready for the new normal, or are you just sitting there waiting for the renewal envelope to arrive? Don't just sit back and let these cold data models dictate your financial future. The absolute best thing you can do this week is pull up your current policy, check your actual rebuild cost, and call your broker to ask about those mitigation discounts. I promise you, 10 minutes of that focused conversation is worth way more than hours of Googling. Thanks so much for joining me for this explainer, and I'll see you all next time.